What's up, guys? Welcome back to the Bumpy Road to $10 million. If you're in your 20s or 30s and are thinking about how to grow your money in the stock market, this series is for you. As a reminder, this video is not financial advice. You should always do your own research before investing. If you haven't seen videos 1 and 2, I would highly recommend going back and watching them for context, as each video in this series is a building block. And if you found these videos helpful so far, please hit like and subscribe below. Now, I wasn't going to spend much time covering ETFs and put options, but I received a lot of feedback, specifically from those without a finance background, that they would appreciate more color around these securities before diving deeper into the portfolio details. So I'll go over it quickly now. If you're already well-versed in ETFs and options, feel free to skip to the second half of this video. What is an ETF? An ETF, or exchange-traded fund, is like a basket of many investments that you can buy or sell like one stock. It makes investing a lot easier and helps investors spread risk and diversify. For example, if you wanted to invest in the S&P 500 index, instead of buying all 500 underlying stocks, you can just buy one share of the ETF SPTR S&P 500, also known as the SPDR or SPY. This clearly makes your life a lot easier, as you don't have to worry about placing 500 different trades, incurring more transaction costs, rebalancing, and so on. In our case, as previously discussed, we are investing in UPRO and SPXL, and these ETFs try to provide 3 times the daily S&P 500 returns. They do this through the use of complex financial contracts, which frankly would be extremely difficult to replicate for the average investor. Now, you pay the ETF manager a small annual fee called the expense ratio for this valuable service. And for UPRO and SPXL, this is about 0.9% or 90 cents for every $100 invested. Well worth it, in my view. Last point on UPRO and SPXL, if you are buying these ETFs, what are you hoping for? You are hoping that the S&P 500 increases in value significantly, because if that happens, you will get whatever return the S&P 500 makes times 3. On the other hand, you should be afraid of downside scenarios, because if the S&P loses, say 20% in a bad year, as a holder of UPRO or SPXL, you would lose 60%. Now, let's move on to put options. A put option gives the holder of the option the right, but not the obligation, to sell 100 shares of a security at a certain price, called the strike price, before a specific date, called the expiry date. So you would buy a put option on a stock if you think the stock price will go down. Say, for example, I owned a put option on UPRO with a strike price of 50 and an expiry date exactly 1 year from today. That means if the UPRO price dropped to, say, $40 at any time within the year, I can exercise my option to sell 100 UPRO shares at $50, even though the current price is $40. So I would have made a profit of $10 times 100 shares, which in this case is $1,000. Now, if UPRO went through a catastrophe and declined to a price of, say, $5, my profit from exercising the same put option would be much higher at $4,500. On the other hand, say the UPRO price stays above 50 for the entire year, then it wouldn't make any sense to exercise the option, and I would lose whatever money I initially spent to buy the option, which is called the option premium. Now, options trade on exchanges just like stocks, and you can buy or sell them through your brokerage platform. They're a bit more complicated to trade than stocks though, because when buying options, you have to specify not only the stock you want to buy the option on, for example UPRO, but also things like the time to expiry of the option and the strike price. Now, in the context of our strategy, the put options are the bodyguards of the portfolio, and they act like insurance. While we hope UPRO and SPXL will increase in value each year, in the event UPRO or SPXL shares go to zero for any reason, the put options will increase in value so much such that the overall portfolio loss is minimized. It's like owning fire insurance on a home. You hope you will never need it, but if a catastrophic event occurs, you're very glad you have it. Okay guys, hopefully that overview of ETFs and put options was helpful. Now let's get back to the specifics of the strategy. We're going to do a live walkthrough of how many UPRO and SPXL shares to buy on day 1. It took a bit longer than I hoped to get here, but now at least you have the minimum amount of knowledge needed to intelligently proceed. And as you're going through the rest of this video, keep in mind that in the beginning, you are investing a relatively small amount and things will not always work out as expected, and that this is normal. So as we previously discussed, on day 1, we will invest $1,000 in total, and we will try to invest 98% in levered ETFs and 2% in put options. Now we're going to buy 2 ETFs, UPRO and SPXL, so that would ideally be an investment of $490 in each ETF, which is $980 divided by 2. In early August 2025, the stock price of UPRO was around $95 and SPXL was around $190. With these prices, you would theoretically be able to buy 5.16 shares of UPRO and 2.58 shares of SPXL. And you get to these numbers by dividing 490 by the respective stock prices. Now, buying fractional shares can get a bit complicated, so we'll assume you round down and end up buying 5 shares of UPRO and 2 shares of SPXL. At these prices, you would have spent $475 on UPRO and another $380 on SPXL for a total investment in levered ETFs on day 1 of $855. And you will have $145 left over to buy put options with or leave in cash. Now, one of the important takeaways from this exercise is that since we are starting with initial capital of only $1,000, we will likely not be able to spend exactly 98% of the initial investment under levered ETFs. In this case, because of what UPRO and SPXL prices are, you would only be able to invest 86% of your initial investment in the ETFs, and that's perfectly acceptable at the beginning. Now, if you can afford to invest more than $1,000 at the outset to buy more UPRO and SPXL shares, then by all means do so, and it will help you hit the target initial allocations early. But keep in mind that the time horizon of this strategy is at least 2 decades, and over time, as the portfolio grows larger, we should be able to easily hit the target weights of 98% and 2% respectively at the beginning of each year. One last point on the levered ETFs, you might be asking why buy both UPRO and SPXL if they effectively do the same thing. And that is a good question. The answer is buying 2 different securities helps us to mitigate disaster case scenarios. I've repeatedly said that this strategy is risky, and in the unlikely event that something unexpected happens to SPXL and it completely blows up, for example, I would be much happier if I had both SPXL and UPRO in my portfolio to mitigate losses. For a strategy like this, it's always good to have redundancies. Okay guys, so by now things should be starting to come together. You should know what all of the securities in our portfolio are, specifically UPRO, SPXL, and put options, and why we're constructing our portfolio this way. You should also know how to calculate how many shares of UPRO and SPXL to buy on day one based on your initial investment amount. In the next video, we're going to jump straight into the put options. As I said at the beginning of this video, these are extremely important. Without put options, I would have likely panicked and sold everything on a number of occasions over the last 5 years. So if this was interesting and helpful, please don't forget to like and subscribe. Thanks for your time, and I look forward to seeing you on the next one.